With a net worth of over $8 billion, Paul Tudor Jones goes down as one of history's greatest all-time traders. What I find really amazing about Paul is he was able to go from being a trader on the floor of the cotton exchange all the way through the years to now being an incredible hedge fund manager. And he's been able to last about 50 years doing all of these different transitions. That's an incredible amount of skill to be able to adapt over all of these different market environments. Not many people can pull that off. Very few have. Now, this video here is part of the Timeless Investing Wisdom series I started with Bruce Kamek. You can see a link at the end of the video. What I really love when people of this caliber speak, it's about pulling out the key principles that underlie their process to the market. It's not about a new indicator or what their current thoughts are on the markets. How do they think? How are they looking at the market? What is their view about how they bring their process together? That's what this is about. Now, we're really fortunate. He was profiled in the book Market Wizards by Jack Schwager, one of the great books about investing. And today I want to go through some different parts of that book. I keep personal notes of all these great investors, and these are some of the personal notes that I pulled out from that book I thought I'd share with everybody. So this is broken down to different pillars of what I think are key pillars of knowledge that he shares through this interview, and I hope you enjoy it. So the first pillar really goes down to emotional control and competitive spirit. So Paul Tudor Jones got into the business. His uncle was already a cotton trader within the cotton business, and he was referred to a very successful trader, Eli Tullis, and he left a big impression on Paul. Now, when he was on the floor of the cotton exchange, Tullis used to trade tremendous size. He could be 10% of all of the open contracts on the exchange. To be doing that on the floor where everyone sees you trading is a tremendous skill because it's not easy to move around that kind of volume when everybody's looking at you. But what the impression that Eli left on Paul was the ability to keep incredibly cool in all circumstances. He was saying his positions could be getting destroyed in the market, and he could be talking very calmly with Paul or anybody else on the floor of the cotton exchange. This reminds me about William O'Neill, another one of the greats we always refer to on this channel. I always speak about when talking about investing. But one of his nicknames was the Iceman. And the reason is that people say he had ice in his veins. He was always cool, always calm. So it's normal to get heated. It's normal. I've been trading on a trading desk for many years. You want to slam the desk, people will get upset, this and that. But the real key is to stay cool, calm, so you always have your head about you. Not always easy to do, but definitely something to strive toward. And a second point he brings about Eli Tullis was he discusses how when everyone knew his positioning, Eli's attitude was, screw it, we're going to go after them anyways, we're still going to make a profit. And years later when Paul became a big player on the S&P futures market, and people could pretty much judge what his positioning was. The things have changed now, obviously, with the advent of algos and HFTs, but before it was much easier to understand what a big trader's position was. And Paul brought on that same competitive spirit. He loves to win. So keeping your emotions in check and really having that drive to win are two key pillars to success. And this is definitely something that even Paul Tudor Jones really puts emphasis on. The next pillar of knowledge that Paul discusses in that interview is about how you have to really understand the dynamics of the market and how volume will impact your trading decisions, especially when you're trading in size. Now, most people don't have the problem of having to be hemmed in by liquidity of the market. Most people are retail investors that can buy and sell when they want. But when you're an institution or you're someone with a big account, you really need to be mindful of the liquidity, the ability to get in and out of the market. So now, even if this doesn't impact you, you have to realize this is how your opponents are thinking in the market. Remember that competitive spirit. You're trying to beat everyone else in this market, and they're trying to beat you. You have to understand how they're thinking, how they're operating. So one of the key lessons Paul got, again, from Eli, who was such a big part of the cotton exchange, was you can't get out of the market necessarily when you want to get out of the market. If you have a big position, a big size, you have to get out where the market lets you get out. So he realized that sometimes there could be a spike in the market, and on the chart, it looks like, oh, the market traded up to 100. But in reality, very little volume traded around there. So he would spend a lot of focus trying to understand where are the key levels of volume so he could know where he could really get out of his position. So when you're looking at a chart, always keep in mind where volume is traded, where there's area of congestion. That really helps you to understand where the institutions were really acting, where are their footprints in the market, and brings maybe a better understanding of what the players are doing in the marketplace. So one story that was so interesting to hear in the book, it's, Paul's talking about one of his devastating days that had a dramatic impact on his trading style, his trading methodology. And there was one day where he had gotten so offside with his positioning. He had so much size on and he was completely wrong on direction. This one loss resulted in 60 to 70% of losses of the accounts he managed. Devastating. Now, interestingly, anyone who had given him money 3 years prior were still up on their money. But that one day just took such a huge part of his equity curve away from him, and it was really, really difficult to deal with. These were his actual words talking about that experience. He said, "I was totally demoralized. I said, I'm not cut out for this business. I don't think I can hack it much longer. I was so depressed that I nearly quit. This is when I first decided I had to learn discipline and money management. It was a cathartic experience for me in the sense that I went to the edge, questioned my viability as a trader, and decided that I was not going to quit. I was determined to come back and fight. I decided that I was going to become very disciplined and businesslike about my trading." So you can see that really pushed him right to the edge of what it was like to kind of be in this business. And you know, it's very painful to see the downsides. Everyone likes to celebrate and cheer on the good parts of this business, and it's exhilarating, probably unlike almost anything else out there. But when you kind of go to that kind of extreme to the downside, and most people who have traded long enough have seen both sides, it either really almost kind of breaks you or makes you stronger. And anyone who's been in this business long enough, you really kind of start to shift away from just focusing on making money and really determining how can I control my risk and how can I sleep at night. Some other interesting quotes from Paul include, "I am always thinking about losing money as opposed to making money. I have a mental stop. If it hits that number, I'm out no matter what. Risk control's the most important thing in trading. For example, right now I'm down about 6.5% on the month. I have a 3.5% stop on my equity for the rest of the month. I want to make sure that I never have a double-digit loss in any month. Don't ever average losers. Decrease trading volume when you're trading poorly. Never trade situations where you don't have control. If you have a losing position that is making you uncomfortable, the solution is very simple. Get out, because you can always get back in. There's nothing better than a fresh start." And lastly, perhaps one of my most favorite quotes from him is, "The most important rule of trading is to play great defense, not great offense. Every day I assume every position I have is wrong." So you can see it's incredible. He comes to the market now with such a clear focus on risk management that is completely the opposite of how everyone approaches markets when they start in the business. Everyone, and with reason, thinks about how am I going to make money? That's why we're coming to this business. But the ironic part is you have to know how to not lose money before you can set yourself for longevity. And that's really the key. I mean, Paul's been around for almost 50 years. That's the difference between someone who wants that longevity or someone who just wants to kind of make as much money as possible, risk it all, and then after likely blow up down the road. So the last important pillar for Paul from that interview that I really took away was that of mindset. So the last important pillar that I really took away from that interview was the concept of his mindset, how he really approaches the market. I know we spoke about emotional control, but emotional control and mindset are really two different things. Emotional control is, keeping your head calm when you're in a stressful situation or not getting too excited when things are going well. Mindset's really how you approach the business in the first place. Even before the money's on the table or you bought some stock, you've bought some futures or options, it's how are you approaching the business? And this here, the way he speaks about this, to me is very eye-opening. Take a look at this quote. "Don't be a hero. Don't have an ego. Always question yourself and your ability. Don't ever feel that you are very good. The second you do, you are dead. Always maintain your sense of confidence, but keep it in check. I know that to be successful, I have to be frightened because my biggest hits have always come after I've had a great period and I start to think that I knew something. I think one of my strengths is that I view anything that has happened up to the present point in time as history. I really don't care about the mistakes I made 3 seconds ago in the market. What I care about is what I'm going to do from the next moment on. I try to avoid any emotional attachment to the market. I avoid letting my trading opinions be influenced by comments I've made on record about a market." So you can see Paul, unlike a lot of people who will speak with such confidence about the market, it's interesting when these professional traders talk, you have to kind of with time understand how to read between the lines. And so what I really pull away from this is, yes, of course, don't have an ego, always, question yourself, be cognizant of the risks. But what he's really saying is, coming to the market, it's really a probabilistic situation. You need to kind of come to this with a systematic process and not start to believe that you are greater than the market, that you solve the equation, because markets are always evolving. I mean, that's why you can look at some people who've had incredible trading careers and then kind of flare out and stop being able to make money or blow up or worse or whatever. There's all the different stories you've heard over the years. So seeing this approach that he has, where it's really, and if you read other stuff he said, it's kind of been beaten into him over the tough times, which has been true for every trader. But having this kind of perspective is someone who comes to the market with respect to begin with, understands they're putting together this process, that they're trying to pull money from the market in a systematic way in really a business-like manner. It's not about being right. It's not about, I know this was going to happen next, here's where I'm going to be right. It's about how can I come to this market, how can I look to make money and always stay prepared, always be mindful of my risk and make sure that I don't make any significant errors beyond normal mistakes that happen by my system. And again, that mental resilience, we're saying that I'm never bothered by anything, a mistake I made 3 minutes ago. We have this almost kind of feeling where because they're worth $8 billion or maybe even back here hundreds of millions or $1 billion, that they don't make mistakes, that they're just like these perfect machines of money printers. That's not the case. Nobody's perfect. I think by them understanding their shortcomings, but probably adjusting for them the best that they can, is what makes them able to have these prolonged periods of incredible returns. So some really cool insight into his mindset. And last up, one of my favorite questions that Jack Schweiger wraps up with on the interview is, what advice would you have for a young trader starting now? And so it's interesting. All these years later, I still find it's such a good thing to hear for anyone who's starting out. Don't focus on making money. Focus on protecting what you have. So it's amazing. This is someone who's made $8 billion, came up from the ground up and grew it and all of this. And he's telling you, don't focus on making money, focus on what you have. So I know for myself, where I started with part-time money, working at McDonald's, and worked my way up into the business and all the rest, looking at something like that, you're saying like, well, look, I'm not coming here to keep what I have, I'm coming here to grow. But the incredible point to that statement is, if you learn how to protect what you have, then you're setting yourself up for really huge growth over time. That ability, the ability to really ramp your equity curve is when you can kind of compound your gains over time. And that only really kicks in if you don't lose your capital, if you don't lose what you're making. And so that's really kind of an important key principle, core concept you have to come to the market with. Because a lot of people will come in and just look, what are good stocks to buy? What's the best indicator to figure out when to buy something? What kind of concentration should I have? This is an entirely different viewpoint. It's all about, how do I keep what I have and grow it from there? That means never mind when to buy. The first thing, the absolute core of everything you do, again, this ties right back up again to the other pillar we spoke of, risk management. Controlling, protecting that capital. If you protect that capital, you're going to be right in the future, but you're also going to be wrong. And if you protect the capital when you're right, you'll make the returns. And as long as you don't give it all up when you're wrong, that's the key to success. That keeping what you have and growing is the key to success over time. So I hope you enjoyed the second part of the Timeless Investing Wisdom series. If there's any other great investors you want me to kind of take a look at and tear apart, I'm sure I have notes on all the greats. Put the comments in the section below. You can follow me on Twitter at trader_mcaruso. There's also my website, carusoinsights.com. Talk to you again soon. Good luck trading.